This is Carrie Gibson. She's with Corporate Tax Incentives, one of our referral partners, and she's going to cover part of our presentation this morning. But we're going to talk about your business, your money, and your taxes. Today we hope to make a presentation that is relevant to every single person in the room, especially if you own your own business. As Lauren said, I've got 25 years of financial management experience in business. I feel like I've done it all and seen it all, and we have a lot of value to offer small business owners, and so let's get right to it. We're going to start our talk this morning with a story about a farmer and his pig. So there was a young farmer, and he was just getting started in his career, and started to work the land. And he had his pet pig. And as he worked the land, the crops came in, and he got to save a little bit and feed his pig. And year by year, things went well. He managed to save some money, and his pig got fatter. And so one year, our farmer had a bumper crop. And so he thought to himself, he said, well, gosh, I could take this extra money and I could go out and buy a parcel of land and have a bigger farm, have bigger crops. And so he went to the town butcher who happened to own all the land in the town. And he says to the butcher, he says, I would like to buy another parcel of land. He said, I've watched you work hard. I've watched you save your money. You seem like a smart guy. He says, I could sell you another parcel of land, but you'd be working twice as hard. He says, but I'll tell you what, I've got this special goose. And I'll make you a good deal on it. He says, but under one condition. For every 3 eggs that it lays, you have to give me one. He thought to himself, well, what's so special about this goose? Well, it lays golden eggs. So the farmer thought to himself, that sounds like a pretty good deal. And so he made his investment in this goose. Your business is like the goose that lays golden eggs. And your deal with the government who authorized you to start your business is that you give them every 3rd egg. So we're going to present a concept here about a few ideas I think that you need to keep in mind as a business owner on how to move money from your business to your piggy bank. In creating business value, there are a number of components that contribute to a business's value: market share, processes, people, policies. There are MBA programs that cover that content. So I can't even scratch the surface of it today, but we're going to drill down on earnings. And from my perspective, there are 5 primary components, financial aspects, to your business's earnings. Number 1 is liquidity. That's why there are bankers in the room. Profitability, we're going to talk more about that. Investments, leverage, and cash flow. Without paying attention to all 5 of these components, your business is going to struggle at some point or another. Today, we're going to drill down on profitability. So profitability is built on these 4 pillars: revenues, margins, expenses, and taxes. You're thinking to yourself, well, Dana, this seems really basic. You're right, it's really basic. But let me point out that you spend 365 days a year focused on revenues, margins, and expenses. I venture to guess that you don't think all that much about taxes except when you make your quarterly estimate. And you have to sit down with your CPA and go over your tax return. So we're going to drill down on that just a little bit further. So taxes. In order for us to talk about taxes and explain what we hope to present to you today, we first need to talk about the different types of business structures. Now, Amanda's an attorney in the room. There are attorneys who dedicate their profession to explaining all the nuances in various business structures. What I've done here is I've just tried to simplify it to give you a kind of a high-level understanding of the various business structures. Option 1, pay as you go. Okay, proprietorships, partnerships, and S corporations, they're based on earnings passing through to each owner every year. Taxes on the income is payable at the ownership level. So in other words, if you have income from your business, it's going to show up on your personal income tax return. That's where it's taxed. It's not taxed at the business level, although in some states it's taxed there. But for federal purposes, this is how it works. Equity is partially after tax. I would say mostly after-tax money is the equity that's in your business. Subsequent distributions are not usually taxed. So there are book tax differences that can change that, that calculus, but for the most part, the money that's in your business is after tax. Option number 2, pay taxes as you transfer. Okay? This is your C corporation. Most publicly owned companies are C corporations, although there are some real estate investment trusts. Earnings are retained by the company, which is where the accountants come up with the expression retained earnings. Here tax on income is payable at the company level. And so equity remains in the business primarily on a pre-tax basis. Subsequent distributions, though, are taxable. So if you own stock in AT&T and you get dividends on that, your dividends is taxed as ordinary income. The equity that remains in the C corporation is the tax on the earnings in the C corporation is paid at the corporate level. Option number 3, you don't pay taxes. You're a nonprofit. I'm guessing at a business summit, there aren't too many people here that are here not for profit. Although I know that there are a few attendees who run 501c3 corporations. If you have specific questions about that, we're glad to help in that arena. But the focus of most of my presentation today is on business taxes. So let's talk about what gets taxed. Again, some of this might seem pretty basic. There are really 2 types of income. There are earnings, which can be adjusted by investment activities such as depreciable assets, non-deductible expenses, Astros tickets. Capital gains is the other form of income, and these are adjusted for your tax basis. So let's say you own a construction company. You go out and buy a pickup. You find out from your tax guy that you can deduct the full value of that pickup under the section 179 of the IRS code. And so you pay $45,000 for the truck. You get to deduct 100% of it. Your cost basis is $45,000, but your tax basis is now 0. So if next year you sell that truck for $40,000, your capital gain is $40,000. That's reportable as income. That's the difference between capital gains and earnings. There are 2 types of accounting. I want to make sure that I explain this clearly because it's really important to understand the differences. If you're a business that's doing less than $10 million, and I'm using round numbers, you're able to do your accounting on a cash basis, and you report your taxes on a cash basis. That means that you don't recognize income until you get it. And you don't recognize an expense as an expense until you actually pay it. The alternative to that is accrual-based accounting. In accrual-based accounting, you record the income when you earn it. So if I do a job for you and you don't pay me until January, that would be next year's income on a cash basis, but this year's income on an accrual basis. So let's first talk about the unavoidable tax. Self-employment tax basics. Subject to your first $147,000 of wages. This flat tax of 15.3% on earnings in excess of wages is combined with your W-2 wages. Let me explain. if you make $100,000, if you pay yourself $100,000 salary out of your business and you have another $50,000 of income from your business, in addition to that, you're paying self-employment tax on the difference, that $47,000. This tax is generally unavoidable because there are executive compensation rules around it. Owner salaries and benefits must be reasonable compensation for services rendered. That means that whatever you pay yourself as a salary needs to be fairly competitive with the marketplace, especially if you're in an S corporation. Generally speaking, this tax is unavoidable. So if you've got a new business, if you're newly self-employed, we counsel our clients to follow these basic rule of thumb kind of metrics. You set aside 35% of your income for taxes. That's enough to cover the 15% self-employment tax plus another 20. If your income's going to be greater than that, then maybe that pushes you into a higher bracket. But I think for most people that are newly self-employed, this will cover your estimates for both your self-employment tax and your income tax. I also encourage everybody who's newly self-employed or you've started your own business is that you set aside 15% of your income into some kind of a retirement plan. So we're going to talk about the self-employment pension plan. We're also going to talk about the 401k plan. But if we get into a discipline of setting aside 15% of our income early on in our career, there are some advantages that come to you as a business owner when things get tough. That means that if you're a solo practitioner, proprietor, is you really should be living on about 50% of what your business is generating in terms of income. Now, I view your economic imperative as your retirement plan contributions. So whether you're using a SEP or whether you're using a 401k, there's something about this that is particularly important for a business owner. It's fully deductible to your business in the way of wages. It's just a business expense. And it's also fully deductible on your personal taxes. You can contribute up to $20,500 this year into your 401k if you're under the age of 50. Next year, it goes up to $22,500. For those over 50, you can add an additional $6,500 to $7,500. So this is taking those golden eggs from your business and deposit them directly into your piggy bank. Honestly, I think it's probably one of the single most important things that you can do as a business owner. Because your rainy day is coming. We don't plan for a rainy day. We can hurt ourselves. But like I said, I was a financial manager in various businesses for the last 25 years. I've seen some rainy days. For example, in the fall of 2008, my family moved here in the summer of 2008, and the financial markets melted down. And so I picked up the phone. I got out of the gym early in the morning. I looked at my phone. I saw the news. I called my boss's boss, and I said, "Hey, boss, this doesn't look too good. We got $10 million of cash in the business. I really think that we should try to get as much of it FDIC insured as possible. What do you think?" And he said, "Yeah, let's make it happen." And he told me a certain dollar amount that he wanted to leave in our primary bank, and we took $6 or $7 million and we spread it across banks across Houston, FDIC insured deposits, because we didn't know what was going to happen next. So let me encourage you as a business owner to be prepared for your rainy day. We heard Jeff speak earlier today about the importance of having sufficient cash on hand. You need to have sufficient cash on hand. I can't underemphasize that either. And I think that it's important for you to maintain a working capital line as well. Frost Bank is here. There are other bankers at the conference. I met with a client, it was in May, and they were a $7 million business. They had $100,000 of cash on hand and no working capital line. In 90 days, we had $1 million of liquidity in their business. So cautiously invest in property and equipment, aggressively manage your long-term debt. Those four axioms, if you want to call them that, I've been practicing for, like I said, 25 years and had a fair amount of success. If we do have a downturn, and the probability of a recession in 2024 still seems likely, there's some things that you should be doing in your business. So, revamp your marketing. We've heard our panelists talk about that this morning. Revisit your staffing needs. Replace or refine your information systems. And by all means, forecast your tax obligations. Lastly, and to the point of my next slide, use Roth conversions when it makes sense for you. Let me explain. This is the federal income tax bracket. A bit of an eye chart. I apologize for that. And so these are the tax brackets for 2022. These are the tax brackets for 2023. Even though there are 7 brackets altogether, there's really only 3 tiers. So there's the 10 to 12% tier, and then it jumps up to the 22 to 24% tier, and then 32 to 37% tier. So the reason this is important in a rainy day scenario is if your income is usually in this tier, and then your business is not going to generate any income, or it's going to generate a loss, and it's going to push you down into this bracket here, or into this tier, this would be a great time for you to do a Roth conversion. So the $20,000 a year that you were slamming into your 401k pre-tax, now you can convert that to an after-tax Roth IRA or something comparable and get it taxed at a much lower tax rate. If your income is usually in this tier and your rainy day in your business puts you into this bracket, well, all of a sudden you've got an opportunity to convert part of your retirement funds into an after-tax vehicle. If you're 40 and you're not going to retire until you're 65 and you do this, so that money that you converted into a Roth now is going to grow tax-deferred for 25 years, and then when you withdraw it, it's tax-free. So how does that not make sense? You're taking advantage of the tax rules and the fact that you own a business and you're willing to weather the downturns, take advantage of the Roth conversion. I think this is probably the most important thing that you can do as a business owner, other than just comply with the federal regulations and so on. So what about tax credits? I have a guest here, Carrie Gibson, and I've asked her to come today. Her firm specializes in certain types of tax credits: payroll protection program, employee retention credit, the others. Carrie?
Do you want to see closer down? Okay, sorry, there's no mic, and I think for the recording. So yes, my name's Carrie. I work with a firm that specializes in lucrative but niche areas of the tax code, and there's 3 listed here. I would say these are the 3 most lucrative right now for business owners that you should be assessing. I can break that down for you by at least industry. So whether you are a business owner or you closely advise businesses, I think it's smart to have a semi-awareness of what these all are. The first one, this one I hesitate every time I talk about it, because if you listen to talk radio in the morning, or you have been, the recipient of probably many phone calls that say you're entitled to $26,000 per employee, or call fast refunds or whatever. All I have to say is this new program, this employee retention credit program, is something that came out under the CARES Act in March of 2020 alongside PPP. Most people heard of PPP, they maybe looked at ERC, and then they put it to bed because at that time you had to pick. You had to decide which one am I gonna go with. And we started I shouldn't say we started our practice, we've been around over 20 years, but we included this into our practice at that time. Really, at this point, the program is something that's available to eligible businesses for all 4 quarters of 2020 and the first 3 quarters of 21. In December of 2020, that whole rule of if you receive PPP, you could not claim ERC no longer exists. And actually not-for-profits can also claim this program. So a lot of stuff changed around the program, but many people were stuck in the old definition because they said, well, I looked at that, I looked at it for my business, it didn't work, I'm moving on, they kind of closed the door. But today it's a refundable payroll tax program that is available to a business that qualifies under 2 possible tests. I don't want to bore you with those tests, but basically were you impacted by COVID? There's a pretty stringent test that you should look at to qualify. I'd be wary of the people that say you definitely qualify, 26,000, all the quarters. I mean, pump the brakes a little bit, right? Let's really dig in. I think the key is to make sure when you are assessing credits and incentives that you are looking at it with a fine-tooth comb. You are not necessarily getting into the trap of saying, oh, my CPA's got it handled. We all love our CPAs. I work with many CPA partners, but they have 7,000 credits and incentives to remember. And I think you're only as good as what you do every day. And these credits and incentives really should be looked at as you are the business owner, right? So that's employee retention credit. It is a refundable program, like I mentioned. It knows no bounds, nonprofits, for-profits, there's no specific industry. So note that. If you are a business owner, you have employees, you were impacted by COVID, assess the program. Or if you have clients who were. Any questions? I see some like troubled faces. We're good? Okay. The other program is a research and development tax credit. That is also a federal, that's a federal program. There are state credits that also have their own R&D credits that somewhat mirror the federal program. The one thing I want to leave everyone with on this program, this R&D, is every time I say the name R&D, people think test tube speakers, lab coats, patents, you know, the biggest of the biggest companies with patents lining the wall. That definition isn't entirely inaccurate. Those companies certainly do qualify for credits, but the credit itself is how the IRS defines this program is much more broad than that. They actually say any company that's developing or improving products or processes or designs, functionalities. So this really touches manufacturers, fabricators, architects, engineers, and even some specialty contractors can qualify for this. So we have winemaking clients, I have breweries and distilleries. It's, again, anybody making or producing things using a technical approach to problem solving. So another area that I would say take it upon yourself as the business owner to dig in a little bit deeper. Don't just assume it's being done. Cost segregation is something that is, you know, if you buy a building or you purchase a building, you can essentially, instead of writing off the entire property over a 39-year period, you can separate the building into different class lives. Obviously, lighting or your AC or carpet or something to that effect would depreciate faster than 39 years. So you can have a formal engineering study done on a property that separates that building into those different class lives, and then you can basically accelerate at an accelerated rate, depreciate those specific components of a building. So all 3 very key lucrative areas that will help reduce your tax liability, generate cash flow, and I'd say kind of keep your head on a swivel for these more unique programs. Proceed with caution though, right? Make sure you're selecting a provider that didn't just show up to help generate a program that's very new and then potentially disappears after the program's over, right? You want to have somebody that's a true partner. Anything else you want me to touch on that?
No, ma'am.
Okay.
So why do we use corporate tax incentives? Number one, because they're experts in this area and they know the rules about whether you qualify or not. Additionally, they'll prepare all the work papers and give those documents to you so that should you ever be examined by the IRS, they've laid it all out for them. Let me wrap up with one last slide, and that is the tax man. The tax man is coming. I know this is a bitter, somber note for us to end on, but I'm still going to give away that Astros gift basket, so hold on just 1 minute. The butcher is coming. Taxpayer enforcement, many people don't know that collections were suspended by the IRS January 1st of 2021. That's almost 2 years ago. Congress has appropriated $90 billion to the IRS in August, effective October 1st. That was just last month. So the service expects to more than double their employment. The IRS has 45,000 employees. They expect to be close to 100,000 by this time next year. All those people need to be onboarded, trained, and given their assignments. So collections will resume January 1st of 2023, and business audits, we expect, will begin next summer. That's not a very good news. Well, sorry to tell you, but I'd rather tell you now than have you surprised. So there's the things that you can do. Prepare now. Number one, know your statute of limitations. So there are statute of limitations behind every single return that you file with the IRS. If you have questions about that, reach out to me, talk to your lawyer. Clean up your books and records. Now is the time. So if during the pandemic, your cost-cutting measures were taking your accounting department of 6 down to 1, chances are you've got some issues in your books and records. And there are companies that I can refer you to who specialize in catch-up and cleanup. Ashley Reyna has Blue Sky Bookkeeping. That's what she does every day. Disclose and amend errors and omissions. We're glad to help you with that. It's far better for you to find a problem on a tax return, disclose it to the IRS in a voluntary disclosure agreement, amend the returns, and get squared away. It almost assures you that the auditors are not going to come. Lastly, engage us. Engage Woodlands Tax. We're your advisors. We're your accountants. We're your advocates. We're here for you. Questions? Yes, ma'am.
Non-for-profit companies, tell me what services you could provide to those.
I had a nonprofit come to me last spring. She was, I think, 14 months into her organization, and she didn't have any tax exemption filed for the IRS. So I said, before we can file your return, you need to file your payroll taxes. Before we do that, we need to get you tax exempt. So I mean, ABCs, the same stuff you'd be doing with your clients, we'll hook them on the tax end. So yeah.
And you can do the tax returns?
Yes, we can.
Do the reviews and
yes, ma'am.
And okay,
yeah.
Awesome.
Yep, you betcha. Other questions? Yes, sir.
One of the things I know a lot of business owners are going through is they're not hearing back from the IRS coming out of COVID. They got refunds that are due. I've heard of people that had big quarterly filings and sent checks in and they were never cashed. Is that something you hear a lot about that the IRS is behind?
Every week. I had a client I was working with a few weeks ago, and he had, I think it was a $20,000 or $30,000 refund from 2019 that hadn't been applied to his 2018, and he was getting regular notices of penalties and interest. And so he reached out to me. I was able to get a hold of Taxpayer Advocate Service, who works with tax professionals. They were able to pull it up. They couldn't find anything wrong with the 2019 return. So they said, we don't see any issue here. It looks like all the documents that need to be, it was something about the W-2, but they had it, and they just hadn't completed it. Everything looks in order. Let me push this button here, and then in 6 weeks, the refund got applied to the balance from 2018, and he ended up, the net difference was $2,000 or $3,000. So, yeah, we'll go to bat for you if those issues come up. The IRS as you may or may not know, took all of their people off the phones to process all the paper returns from 2021. Commissioner Rettig, who we got to hear in Las Vegas in July, said that we will be caught up by the end of the year. And so hopefully they'll have all the 2021 returns and prior processed by the end of this year, which is why they're going to turn the phones back on in January.
We see that a lot in the tax credit world too, with refunds that are supposed to be coming through various credits and incentives. It's taking significant time.
Other questions?
Definitely don't call them. Be on hold all
Israel.
afternoon.
Yeah, you mentioned moving money into Roths.
Yes, sir.
Can you do that out of a 401k?
Yes.
If your employee's 401k?
Yes. But you have to do it. You have to do your conversion in the year in which you want the income taxed. So if you want a conversion for 2022, you have until December 31st to get that done. I called a couple of investment company providers and just asked them, I said, how fast do you guys get that done? He says, yeah, if you fill out the form and tell us you want to convert all or part of it, it really happens in a day. So they can make it happen very quickly, but they would probably appreciate it if you didn't wait till December 30th. If you need to convert this year.
So are you familiar with solo 401k as far as so you have an individual person business, right? Using a solo 401k as a non-Roth entity, right? So you put in your contribution plus you put in your profit sharing, which increases the amount you can put into that, correct?
Uh-huh.
You're familiar. Is that as an entire balance convertible to Roth because of the split between personal and profit sharing?
I believe the answer to that is yes, but if you want to give me your card, I'll check on that just to make sure.
Yeah, okay, I won't bother. Thank you.
Okay, we're about up on time.